when it's your full-time business and job of developing things, you've just got to keep developing them and hope that you pick up some wins on the way and hope that you pick up in the revenues when you go to sell them.
You are listening to the Property Developer Podcast, your home for tips, ideas and inspiration to help take your developing to the next level. Now here's your host, Justin Getty.
Hello and welcome to episode 107 of the show. Thanks for joining me. I hope you're well. I'm doing fine. Pretty busy at the moment because as I'm recording this, we're at the end of the year and the builder reckons they're going to achieve practical completion in the next week or so on my project that's been bubbling away for a couple of years now. And that's exciting that they're nearly finished, but the industry shuts down in about 2 weeks. So there's a mad scramble to try and wrap everything up before that break. The builder reckons they're going to achieve practical completion in about a week. I'm not sure that they're going to get there, but we'll see. There's a whole bunch of defects to fix, and then all those final items that get done in the big push to the finish line. So it'll be great to get all that wrapped up. It's been a bit of a journey, and I might share some more about that in an upcoming episode. So dealing with that has been taking up quite a bit of my time. On my other project, we've just been fine-tuning the floor plans and doing some more work on the site level so that we can get the earthworks underway early in the new year. So busy end to the year for me. I hope it's been a productive and exciting end of the year for you. It's been a great year for the property developer training. I've had lots and lots of people signing up. So thank you to everybody that has joined the training. I'm very excited for you. They're going to be making 2024 a great year. And if that's something that you want to do, you want to take action on that dream of becoming a developer, then please check out everything that's available at www.propertydevelopertraining.com. I've just added some new content into the training, which was a discussion I had with Mark Lovett, who was my guest on the last episode of the podcast, where we both shared our top 5 things that we would suggest to fledgling developers on what they should focus on if they want to succeed at property developing. So that was a really awesome conversation, and that module is now in the property developer training. So if you want to get started in developing, please check out everything that's in the training. I'm sure you're going to love it. If you want to find out how ready you might be to get started in property development, be sure to check out the quiz at propertydevelopertraining.com/quiz. And remember, you can always find me on the socials, particularly on Instagram and Facebook. I have been putting up lots of videos about how my project is coming along and how it's looking now that we're getting close to wrapping up. So if you want to check out what that looks like, then head over to the handle of Property Developer Podcast and take a look. So before we get into today's guest, I just want to take a moment to say a big thanks to you for tuning in throughout the year. I hope you've had a productive and prosperous year, and I wish you all the best for 2024. And please keep tuning in. I've got a lot more episodes left in me with great guests coming up. Okay, on to today's guest, a regular on the show, Dan Holden from Holden Capital. For those who don't know, Dan started in property in 2001 as a development manager for projects, before moving into project finance and then founding his own firm in 2011. He's since won Commercial Broker of the Year 3 years running, and Holden Capital is Australia's #1 specialist construction finance group. So he certainly knows his stuff when it comes to developments and development finance. Dan has featured on episodes 14, 35, 56, 68 and 96. They're all worthy of a re-listen or a listen if you haven't heard them yet. We cover really awesome territory in all of those conversations. In this conversation, we are going to take a look at the state of the lending market and what's ahead for the next 12 months. We cover how construction delays have been affecting projects, the impact of rising costs, and how lenders are responding. There's a lot to get through, so let's jump right in. Dan Holden, welcome back once again to the Property Developer Podcast.
Thanks, Justin. Good to be here.
I've lost track of how many times you've been on the show, so fair to say you're a regular guest, which is nice.
Yeah, no, it's good to catch up and I guess share some insights.
So I realized it's been pretty much exactly a year since you were on the show. So it was remiss of me not to get you on before now, but here we are. I wanted to have another conversation about finance and what's happening in the funding markets. So given it's been a year, there's probably going to be a bit to cover because quite a lot has happened. I think about a year ago, the cash rate was hovering around 1%, and it's gone up significantly since then. So why don't you give us a bit of a look back, a wrap on the year and where you think we're headed next year in 2024?
Yeah, absolutely. So I guess starting off with that cash rate and how it's impacted project finance and the world that we live in. It's funny because always been heard the saying in kind of the non-bank lending space that, you know, if a project is that fine margin that you need bank finance to make the project work, then the project doesn't stack up anyway. But now we're seeing, you know, the difference between you used to be able to borrow at bank rates maybe 18 months ago when the cash rate was zero, and now it's gone up, I think, 14 or 15 times since then. And now the non-bank lending rate is pretty much at 10 or 11%, no matter where you go. Everyone seems to be kind of moving with market forces around the same kind of rate and the same kind of terms on offer. It definitely has knocked a few projects around viability-wise, particularly when you couple it with the increase in construction costs, an extra couple of months to finish projects. We're seeing plenty go over time, over budget. It's definitely knocked quite a few things around. And I guess many that we're seeing now, I'd say more than half in the last 6 months that we see, pretty poorly viable. Whereas if you rewind, 12 months, 6 months ago, they all would have had a lot better, better outcomes, better viability, better push ahead. So we're seeing a lot that get either mothballed and parked for a period of time, or some that are, I guess, already pregnant and they've just got to push on and just get it done, either because they've already cleared the site or, I guess when it's your full-time business and job of developing things, you've just got to keep developing them and hope that you pick up some wins on the way and hope that you pick up in the revenues when you go to sell them as completed products. And thankfully, we are seeing plenty that are benefiting from that. The finance that we provide, we don't require pre-sales. Sometimes we fund projects that have them because they were trying to get bank finance and they got frustrated and they end up coming to us to fund it without pre-sales. But we're definitely seeing ones that are finishing now getting a better result than their pre-market valuations. And you say, well, obviously, because that's, what happens in a year or so. But we've also seen in the last 12 months compared to the 12 and 24 months prior to that, where the market was going up at a rate of knots, it's definitely calmed down. And some people would say gone slightly backwards during 2023 in terms of the revenues and where people were projecting them to be. So we're seeing the developer picking up the benefit mainly through it just being a completed product. People can buy it, move in 30 days. And I guess a lot of that fear around engaging a builder yourself as a mum and dad non-property person, that is very evident now in what we're seeing in raw land sales of land subs that we're funding. But also you're seeing that flip side, when you've actually got completed products that people can move in 30 days time, you're seeing that it's actually being competitively bid for, and that's where the developer's picking up the benefit by having stock that is ready for sale and ready to move into. So yeah, overall, I guess the year has been, probably the themes that we've seen is definitely the extra 4% interest rate on the cost of funding has made some things less attractive and less viable. But when you couple it with the increased construction costs, which we think is coming down slightly, it's made quite a number of projects not as viable, and a number have had to go back to the drawing board and reconfigure or approach things to try and make it worthwhile.
Yeah, there's quite a few points there that I want to tease out with you. just with the sales of completed stock, I mean, that's something that I've witnessed and experiencing myself at the moment with a sales campaign. Even being very close to completion, buyers are still wary about finalizing a sale. They actually want the product finished. They want to be able to walk through it, keep the light switches on before they'll commit to a contract.
Absolutely. And yeah, the feedback I'm getting is unless they can settle in 30 days, they don't want to touch it. If it's subject to this and subject to the driveway being poured and the lifts being installed, they're just still hesitant to part with their deposit and sign a contract that they could end up tied up with for months and months. So yeah, it's definitely interesting space. And as I say, it conversely has a benefit and a disadvantage to people selling raw land that isn't attractive anymore. And where I think 3 projects we're funded this year, we've actually included funding for sticks and bricks construction for the developer to do to sell completed product. So let's say we cut 36 blocks of land. We've included on the tail end enough extra funding capacity to put up 10 sticks and bricks so that they could sell completed product. And the other 26 lots, say, would mainly be going to other builders who will then buy it on builders' terms or settle and then fund a construction of a new house themselves so that they can fund it. But you're not getting bowled over in the rush anymore with these, not speculators, but the people who are happy to buy a piece of land, go to a builder's display village, pick their preferred builder, put the whole thing together themselves and take that, both the management of it, but the risk of it. And that's mainly around, cost overruns, time delays, them paying the mortgage the whole way along. There's all that kind of stuff that we're hearing back secondhand that is causing a bit of a gap in that market. And conversely, if you've got product that is built, you're just seeing it not walk off the shelf, but definitely there's a huge demand there for it, which is good to see.
Yeah, well, I can certainly attest to the delays getting stuff built as well. I think we're probably going to be about 12 months behind schedule by the time my latest project finishes. So it's been a real battle out there. I'm sure I'm not the only one.
Definitely. I mean, we've seen, some, that we're funding that we've seen similarly where it should have been a 12 tops 14-month build, and they're in month 20. And it's not, and the frustrating thing is it's not even through bad management or, neglect or anything. It's just that's how long it's taking to get, particularly quality jobs done. And, I guess some factors we've seen for that is builders taking on more jobs than they can handle in a given month and scheduling because they just want to lock it in and have surety of future work. That's one particular thing. I know 2021 and 2022 was filled with availability of materials and supply of actual product to help construct the thing. But now it seems to be freed up, and now it seems to be actually just labour and getting, guys on site. You've probably heard the saying, the white ute test. When you go to a site and you see a bunch of white utes there, you go, excellent, this thing's actually pumping along and we're going to get some nice drawdowns. I mean, we see it in our monthly drawdowns. We're funding 30 or 40 projects at a given time. And so every month on every project, we see the drawdown and we go, well, hang on, you've got a $6 million loan here. You should be drawing down at least $500,000 a month, and you get a drawdown for 180 grand. You go, oh, what happened this month? Nothing. Like there's just, so then we look at the cost complete, and you can see that graph in the QS report where it says projected drawdown and then actual drawdown. And it's like, what's happening? Like there's just crickets. And yes, I mean, some developers are on site themselves trying to hurry things along, and there's just not much they can do. I guess it's choosing a good builder and choosing appropriate finance, and some of them are being benefited by that by the time you actually do deliver. The lack of competing projects means that you end up with a better result in the GR, but it's you lose a few hair follicles trying to battle it until you get there, and it's definitely proving, I think, more challenging for the junior developers to who might have just started to actually find their way through and navigate it in a calm, relaxed manner. It's definitely more challenging, and I think the barrier to entry is probably a little bit higher now for property developers to be in there making a start.
Yeah, well, you've just described my monthly experience, Dan, watching my project, the QS report with the projected cash flow versus the actual, and the gap getting wider and wider each month.
Yeah, and it's frustrating as well because you see the cost, blow out 200 grand on the build, and then you know that your interest bill is also going to blow out another 80 grand for the extra 2 months. And unless you do it, you've picked a good location that is going to benefit in the GR. Sometimes it's just your profit margin dwindling every month as a result. So it's definitely the time to be strategizing and thinking about ways you can deliver it better and smarter and faster.
In normal times, lenders would be looking at a 6-month blowout or a 10-month, 12-month blowout and just thinking, right, we're going to have to do something here. But given it's happening across the board, and I know lenders in general are being fairly tolerant and understanding, or at least the good ones are, What are you seeing and hearing across the lending sector in terms of their views about these delays, and how long are they going to allow it to go on for?
Yeah, I think you're right. We've been, pretty orderly in the way that most of the lenders have carried themselves, which is great. And a similar, compliment. I've been funding since prior to the GFC, and a similar compliment to the lenders back then that, sometimes as a lender, the worst thing you can do is rush in and put an MIP, mortgagee in possession sign up and kick the current operator out because they've got, the IP, the, intellectual knowledge of the project and where things are, where the variables are, where the risks are. The best guy to manage it is the guy who's currently there. Unless he's, no money honey and can't contribute anything to really see it through, you're better off working with the current person to get it done. I'd say in the last month, we've seen a pretty marginal increase in site sales for MIP. And that really comes down to, lending on a development site is probably the more riskier lending that you can do as a lender, because the only way out is construction or sell it. Particularly when you see guys demo the house, you go, well, now you can't even sell it as a house, to a first home buyer because it's just a vacant site. So we're seeing the site sales MIP tick up in the last month. I've noticed it considerably. I think there was some prior that were not MIP. It was just, hey, it's time to sell or repay us, or either give us, say you've got a 2 mil site loan on a 3 mil site, you can either give us 200 grand to prepay your next 6 months of interest, and if you don't have it, then you've got to sell it yourself. We're seeing that now in more severe situations. The lender's just appointing MIP and saying, sorry, you can't do it. And to expand on that as a lender's point of view, the reason why that, lending 65% LVR on a site purchase, 2 mil on a 3 mil site purchase, the reason that is risky is because that 3 mil site that they've purchased and now have DA for, construction quotes, it's shovel ready. Generally speaking, if you're geared that highly on the site purchase loan, when you look at the construction funding table, they're probably, that project is probably a 10 mil TDC project, 14 mil GR or thereabouts. On a 10 mil TDC project, most lenders are going to pull up at about an 8 mil loan to cost. Banks are going to be 7.5 mil, even 7 mil as the loan to cost ratio. They'll want to see 25, even 30% of the equity of the TDC in the capital stack from the developer's equity. And sure, that can be a little bit of uplift from buying it well and adding value, but most of the time they want to see hard cash. So if you're buying a 3 mil site that has a 10 mil TDC, you need, particularly with bank funding, you need 2.5 mil of cash in that deal. So if we're as a site lender, we're owed 2 mil, you've only got 1 mil in the deal, you need to either win lotto, finish your other project, or some event has to happen between that site loan and the construction funding being real and tangible and viable. And so that's why site lending is a higher risk for us. I just thought I'd expand on that, because people sometimes say, well, what do you care? Just lend 65%. It's easy, right? And you go, well, it's actually not. And even if we look at that as a lender ourselves, knowing we're going to do the site loan and then roll into construction, and we do that plenty of times where we go, yep, help you buy the site. Before we lend the 2 mil on the 3 mil site purchase, we're looking at the overall portfolio of projects the developer has, the balance sheet available for them to put into it. And if, for example, we needed to fund the 7 mil construction for the 10 mil TDC and it needed 2 mil in, and there was no event happening in the portfolio between now and then, it means we end up having to, essentially put ourselves in a mezz position for another 12, 15, 18 months. And so that's why it has that higher risk portion to it. Whereas if we can lend someone 2 mil on a 3 mil site purchase and it's November 23, and we can see that in March and April, they've got their last 10 pack that they're just finished now, settling, selling and putting money back in the kitty, we can see that it's going to be organically roll into being a project. But if not, and the current project stalls, stumbles, all of a sudden we're at 2.5 mil on a 3 mil site because they haven't had the money to put in to keep the interest bill alive, and they don't have the balance sheet to actually get it out of the ground. So, yeah, there's a number of risks in site lending, and that's what we're starting to see now is those loans that were probably 6 months ago, 9 months ago. Yep, should be right. No worries. 65 LVR on a site loan, no problems. We're already starting to see problems come up in that across, not just Brisbane, but also I've seen them in Sydney. There's been a heap in Sydney recently, and that's around undercapitalised developers, the ones that I've seen anyway, and there's been at least half a dozen undercapitalised developers who can't actually turn that site loan into a project. And so, yeah, it is a high risk category for us as a lender.
And then touching on construction costs, because they are elevated and they've been moving ahead of end sales prices, which has been causing issues with feasibilities. There has been some stabilization in some parts, not all, and there are higher construction costs at the moment. So what are you seeing in terms of how developers are approaching that?
Yeah, so I think it's hard when you're already pregnant with a project that you've got to push ahead with. As I commented earlier, I've seen a number of developers just push ahead anyway. And, we have funded and have been asked to fund a bunch of projects that don't necessarily work from a project viability point of view, but they still want to push ahead. I'm generally in support of that, so long as the developer's strong enough, experienced enough, and that they're taking an educated and informed punt. Because if you're building a 10 mil TDC project and the valuer says the GR is 11, it doesn't sound really cool, right? But if you know that they bought the site in June 2022, which I think was roughly the height of the excitement in the marketplace, they probably just paid too much for the site, and it's probably they should have bought it for 2, but they've already bought it. The construction cost, they would have loved it at 5.5, but it's now 6 and a bit, and the GR's probably softened 8 to 10%, and so it just doesn't look pretty, right? But if the developer's well-heeled and got good experience and got a good balance sheet, and they still want to push ahead with it, I'm generally in support of that, and I've funded a few of them like that. But they're hoping to pick up some wins on the delivery, and they're definitely relying on picking up a decent amount in the GR. But also, they've in those numbers and those metrics, they've probably got $1.5 million tied up in the thing anyway that they want to see through and realise and get it out. And so, how we fund that as a lender is essentially we lend on the project-related site value of that TDC, so that we still see enough hurt money and cash equity in the deal that we know they're going to see it through and get the project finished and get that out. So, if it was a 10 mil TDC project, it's probably now a 9 and a bit mil TDC. We'll lend our gearing ratios on that adjusted TDC amount. But some lenders will just say, I don't want to touch it at all. We'll generally try and roll the sleeves up and see if we can solve it.
Yeah, that's another thing that I've been hearing and experiencing myself is just around softening valuations.
Yep, it's definitely one that I think again, if you're applying the same, the rigid metrics on the projects that you're buying, and not just buying it because you need another project because you haven't bought one in 3 months, therefore you need to buy another one. If you're buying projects for the right reasons, you generally find it won't be as bad. But we have seen, some bad examples where, you take 10 or 15% off the GR and you add 10% of the costs, add another 2 months to the delivery. You sensitize it on all areas, which is basically what's happened in the last 18 months, right? Everything's copped a bit of a knock, and it just doesn't look as pretty.
Yeah, it's been a bit challenging, and all the time, or particularly in the last year and continuing ahead, people piling into the country. New migrant immigration tap is fully on.
But I think that's what's going to save projects as well, because we're seeing, we haven't seen property prices fall off a cliff. We've just seen them possibly correct. And if anything, most of the mainstream media anyway is saying that they're back on the rise and it's full steam ahead. So, and if you look at the sheer replacement cost of anything, you kind of go, well, it has to go that way, really, because if you're after new product, sexy, shiny new product, the buyers are just going to have to pay to get in and get the the new shiny stuff. Otherwise, they'll be living in 50-year-old older accommodation to suit their budget, not the newer sexy stuff. And there's always been a decent premium between new and sexy and shiny and infill metro versus an old house that you need to spend 5 or 10 grand a year renovating each year. So I just think maybe that gap's got to increase a bit.
Yeah, and it's funny in terms of getting insurance as well, because I've just been looking at that for my project, which is almost complete, and then the cost, the project build cost versus the replacement cost is already different. So whatever it's costing us to get built is actually not what it would cost to replace if it started again today. It's like 20%, 25% more. Yeah.
It's a funny little thing, but be interesting to see how it plays out.
And it's a real patchwork across the country in terms of how markets are going and how developments are going. I know it's different in Melbourne to Sydney to Brisbane to Adelaide to Perth. It's like a real patchwork going on.
I think, we're active in Brisbane, Sydney and Melbourne. We used to lend in Perth, but we did a couple and decided there was easier things to do. So we now just do Brisbane, Sydney and Melbourne. I think we've probably got 30 active projects in Brisbane. I think we've got about 7 or 8 in Sydney and probably 4 in Melbourne. So we are across all of those markets. I guess also we only fund short form construction. So, we don't do multiple basements. We don't do kind of crazy long term, which I think is higher risk. So most of the stuff we are doing is, 30 lot land sub, a childcare centre, 20 townhouses in a stage. It is that short form in and out. And so if you do cop a bit of a knock on costs or a bit of a knock on the GR, it's usually not a massive magnitude. Most of the loans we fund are between 2 and 15 mil per loan per project. So we're seeing definitely seeing some differences amongst the projects, but overall we're seeing most people see it through and get the job done and get on to the next one, because most of them are full-time property developers. That's how they make their money. They've got to get out there and trade property. They're not there to collect it and put it on the mantelpiece. They've got to turn it over and keep things moving.
Actually, speaking of how long it can take to pull a project together, I've just finished reading a book called Billionaires Row that you might be interested in, about the super tall towers in New York that got built in the last sort of 15, 20 years. Okay. Those projects, that's how they take 10 or 15 years to pull together, while these guys accumulate properties at the base so they can build the towers up. And it takes them 5-6 years just to accumulate the properties, and then 10, 15 years to make it all happen. And the capital stacks on those things are ridiculous.
Amazing. All right, I'll have a look for it. Sounds good.
You'll enjoy a book like that. I touched on the valuations and how that's affecting land values and end values. Sponsors are having to throw in more cash. At the time that we're talking, the Queensland government's just announced a boost to the first homeowners package, which seems like throwing fuel on the fire. What's your view about that?
Yeah, so probably only a couple of projects that we fund have exposure to that. So one of our clients, long-term clients, is a house and land developer, and yeah, hopefully they see some benefit from it. Most of the other stuff that we are funding is either empty nester or medium higher end, third and fourth home buyer type stuff. As in the price point is more luxury; it's not entry level. But yeah, we've just actually we're settling one this week for 36 lots land sub. So, but hopefully by the time they're ready to get the sales in, that helps the buyers. It's normally that outlying regional fringe stuff that you see gets the benefit from that. So yeah, hopefully it does help kick things along a bit and gives a bit of a boost.
And then what about casting our eyes forward, Dan, to 2024? What are you seeing there or hoping for?
Yeah, so I mean, I'm hoping that it goes back to being boring and being predictable. I think that's the hardest part that we've faced over the last 2 or 3 years is just property developers have taken a knock from here, there, and everywhere, and I'm just hoping it goes back to being boring, predictable, measurable. That's the ideal scenario, is that that the costs might go up 5%, but your GRs go up 5 or 8%, and that you're able to see the project through in an orderly fashion and not have things come out of left field. I've seen plenty of projects in the last 12 or 18 months cop a 2 to 3 month delay just from like one issue, like titling or QU or connecting their services to the adjoining neighbour, or little things like that you kind of can't, no matter how well you are at managing things, they still pop up and you still kind of can't overcome them quickly enough for them to until they've taken a bit of a dent in your project. So I guess hopefully just back to boring, simple, manageable problems. And it feels like it's getting that way with construction costs calming a bit, with less job starts. There's hopefully more available labour to deliver these things on time and potentially on budget. The costs have gone up astronomically in the last 3-4 years post-COVID. Hopefully that calms and things are predictable. Like, I think that was also what was seeing the frustration for property developers, was that they, by the time you contracted a site, the quote you had was 4 months ago, and all of a sudden you've got to add 20% to actually sign a contract with a builder that was available and ready to take it on. And then you still get construction cost increases during the project. Even up here, particularly on the Gold Coast, trying to actually find a builder that can do the work when you're in that middle market of 10 to 30 mil build contracts, there's hardly any builders that you would want to do the project that are actually available to do it. And the ones that are able to do it will only do it for people they know and like and trust. So just because you're a new developer on the block and you want to try and buy this cool project and do it, a lot of the builders in that space are only dealing with people they already know, for risk of project completion, for risk of payment, for risk of the way they're going to carry themselves and carry on like a goose through the whole project. It's just not worth the risk for them with what they've been through to deal with a new person they don't know. And it's probably somewhat similar for us in the lending space, where if we're got enough, if we can fund 40, 50 projects next year with our repeat clients, why do we need to take someone on that we just met yesterday on a Zoom call who says they're all great and fancy and whatever, and yet they've got not a strong balance sheet and not a strong project history. It's getting back to proper relationship lending, and the builder space is exactly the same. In this market, it's not the time to go cheap or tacky or trial new builders or new lenders. You want the guys who have been there, done that, and are going to be there to help you see it through.
So do you think we're going to have a stabilisation in the cash rate through 2024?
It's definitely looking that way. I was reading something this morning that Switzer said, economist guy, kind of saying, yeah, we'll know in the next kind of 2 or 3 weeks if February's, but hopefully that would be the final one. So yeah, from 4.35 to 4.6, they're kind of thinking that would be the final clincher to get things to calm down. I think they were saying the wage growth that came out a week or so ago was the real killer that pushed it up at Melbourne Cup Day. So hopefully it calms down. And I think what's interesting and what we saw between the cash rate rises from where it was. So 18 months ago, the RBA was 0.1. It's now 4.35. 18 months ago, we were lending money at 6.95. We're now 9.6. Potentially have to push to 9.95. So even though they've gone up 4.5%, we've only gone up less than 3. And yeah, so it's interesting that it's not necessarily directly correlating. Some lenders chose to go RBA plus or BBSY plus. We kept our lending at it's the same rate throughout, so it's more manageable for the borrower, and that we find is the fair way to do it. So yeah, I think they're saying that, or Switzer and other economists are saying, the end of 2025 it might see some calming and potentially reversal, but they're seeing 1% maximum. So if it did get to 4.6 by the end of 2025, it might be 3.6 as a cooling or mechanism. But yeah, you never know. They might need to turn the wick up real quick and drop it 2%, but it doesn't seem that they do.
Well, it's going to be interesting to see. I think, as you say, it's stabilization that people like. It's the rapidity or how quickly things change that really upsets a lot of people. It's very hard to manage when there's that frequency of changes and things are going up so quickly.
Yep. I think it's hopefully more calming ahead.
All right, Dan, anything else you wanted to mention before we wrap things up?
Yeah, probably just, I guess, a little synopsis, or my synopsis anyway, of the lending market. So we've had banks kind of did come back a little bit, as in that they were wanting to get money out. They were wanting property developers as clients. I wouldn't say that, they were trying to get money out, but they were more open to having property developers as clients. Obviously, property developers to a bank is a risk category they don't love, but they obviously love lending money and doing loans, but just not necessarily the property developers. As a group, they generally put them together and lump them together as a risky category. But we did see the banks kind of, put in a bit of effort, I'd say, is the polite way to put it, this year, which is good. But obviously, to get bank funding, you need a good balance sheet, good history, preferably an arm's length builder. They're still a little bit tough on owner builders. You need a decent amount of cash to put in, because they're only going to fund 70 or 75% of TDC. And so what we're seeing there is that the non-bank market, which is generally more flexible, lower pre-sales, they'll lend you more money, so you're putting in less cash. They'll take on slightly less experienced developers, and if you haven't done it for 10 years, they'll still look at you as a borrower. And so the premium that people are paying for that, like at the moment, we're, I think, 2.5% more expensive than a bank. They get back in benefit. So it's, cost benefit analysis that it makes sense to do. And what we're seeing is that, the non-bank lending market has risen in the last, 3 years, 4 years, and become quite dominant. Definitely in the above 25 mil loan category space, it's become very competitive in the last 2 years. There's been a lot more superannuation money being pushed into our sector. They're seeing it as kind of 10% per annum for them as a return to invest in funds like ours, as being a good safe bet. First mortgage, 65% LVR, good experienced sponsors. So we're seeing that above 25 mil space being very competitive. The space that we're in, the kind of 2 to 15 mil, there's been some recent entrants. I've seen more than 3 retreat out of construction already this year. So they were maybe doing home loans and thought, we can do construction. It can't be that hard, right? And then 3 of them already this year have packed up and gone back to wherever they came from. 2 loans that we did this year was from a lender like that, who essentially went, we don't want to, see this thing through, and we don't want play in this space anymore, basically. So yeah, it's not for everyone, and that goes back to my comment before about builders and lenders are not the kind of trades or consultants you want to trial and hope they know what they're doing. Because yeah, we've seen a couple of examples where they didn't, and it ended up costing the borrower, new establishment costs, new mucking around, new everything to get that done. And likewise, we've actually done probably 4 loans this year that we've taken over another lender position to see the project through. So they've taken a 12-month construction loan when they probably needed 15. The current lender's gone, yep, but if you need to put in 700 grand cash to keep this loan facility and kick it another 6 months. And so we've come in with maybe 2 or 3 progress claims to finish and given them another 6 or 9 months to finish the job properly and carry out an orderly sales campaign and get the project finished in due time. So, even those types of things, it's worth just keeping in mind when you're interviewing lenders like us or coming to us as a broker, that you have these things in the back of your mind, like a little shopping list, checklist that you want to think at, just the same as you'd have when you go to approach a builder, asking what other jobs they're doing, asking how they treat, time delays, cost overruns, all that kind of stuff. They're the same questions you should be asking us on the financing side is, how long you've been doing it, what do you do when things go wrong, all these types of things. As I say, I'll just repeat again, it's not the time to be trialling a guy having a go at being a builder or some company that has done home loans for 10 years and you're their second customer as a construction borrower. It's not the time to be trialling any of that stuff. It's go with the tried and proven.
Well, I would argue there's very few times during a development to do that, Dan, to be trialing.
Well, we're seeing people do it though. Like, yeah, these lenders that thought they'd have a crack at construction lending, and they're retreating, and the borrower probably didn't think they were doing anything wrong, but now they're having to find a new home and in a hurry in some cases. So it's as they say in building, you usually shouldn't pick the cheapest quote because they've probably missed something. We're probably seeing similar in picking a specialist construction lender that knows what they're doing and can handle things properly.
Yeah, well, in my property developer training program, that is a message that I stress to people, particularly when it comes to getting construction funding. You want to be talking to a lender or a broker who actually knows what they're talking about, not somebody who says they're a broker and can help you. That is not the way you want to go. And same thing with the builder. You want to make sure that you're finding a builder that can build the stuff that you're doing, not somebody who's having a crack at that for the very first time.
Yep. And same goes when you're picking the valuer that is going to do the project valuation, the QS that you're going to talk to every month for your drawdowns. Picking the right consultants on that stuff also helps. Some lenders only give you one choice, or don't let you talk to the valuer because they don't want you to coerce them into thinking something differently. We think it's better for the valuer to meet the developer on site and have a walk around and it's up to you to pitch your project to them. Why did you buy it? Why do you love this project? Why is it the best project that's coming out of the ground this year? You should have that face-to-face contact with them to explain all the reasons that you love this project. Whereas some lenders say, no, you're not allowed to talk to them. I don't want you to meet them. I don't want you to coerce them. It's pretty hard to coerce a valuer. Most of them think the sky's not blue, it's grey, and convince me otherwise. So we're pretty open to all that stuff. And likewise with the QS, you're going to be interacting with these guys most months. You're going to want to understand what their view is on some things. What about pre-ordering things before they're on site? How do we pay for that? What about, when the lift gets there, how do we claim it as part of the progress draw? Have all those discussions up front so you know how things are going to be approached. Otherwise, it comes to the moment and you don't know and you freak out and you have a tantrum and you look like a goose and you're the one that looks silly in the end if you don't ask all these things up front. So I'd definitely say, interview your valuer, the QS, interview the builders, interview the lenders, ask them all these questions and get comfort that they're the right people doing the job for you.
Yeah, it's funny you mentioned the QS because over the last 18 months on my own project, he has actually probably been the most crucial person that I've been talking to and getting advice and help from when things have been really challenging. And if you asked me that at the beginning of the project, I just wouldn't have believed you.
Yeah, it can be critical, particularly the amount of cost overruns, time delays, and everything we've had on nearly all projects in the last 2 to 3 years. They're the guys who are going to come up with some weird and wonderful solution that you'd never thought of because they're working across so many different projects at that one point in time. It's like us. We're funding 30, 35 projects at any one time. We're seeing what everyone else is going through, and we're coming up with solutions how to help these projects get finished. We're there as a resource, not just to borrow money from. It's you want those guys on your team. I mean, that's why I think one of the guys you've had on your podcast, we've funded, I think, 15 or 16 times in the last 2 or 3 years. He sees us as part of his team, that we're not on site building the thing for him, but we're part of the team delivering that project. It's not just, here's my QS, send me my money. It's you're actually involved in the process and helping them, I guess, helping their business grow. You're part of that journey as well. I've got one client that I first funded their first project in 2007. So we're going back, 16 years, and I'm still funding their projects today. I mean, that's the journey that, some marriages don't even last that long. And yet I've been funding that guy's projects for 16 years. And we're literally settling one this Thursday for him, another $4.8 million loan on a 36 lot land subdivision. And, we're still doing business today, helping through that whole journey. It's something that when you actually treat your consultants like they're part of your team, you get a really good outcome because you're in it together.
Yeah, I often talk about putting together that A team, trying to get your A team together, and how it's a evolutionary process of trying to find the right people to make up your team. And I think it's a good point that you make when you find consultants and people who move beyond just providing that functional service to a much more of an advisory role, and it just takes everything to a whole new level.
Absolutely. And building that project team is important. I will give my book a plug up here, where there is a chapter on that, is building that right project team, because I've done both project delivery myself and financing since 2006. I think it's a critical aspect that I think some people just treat pretty lightly. I think it's something that is worth investing that time, and that's why I say go and interview the value of the builder, the lender, the QS before you need them. Go and have that meeting and just get to know them, get familiar with them, ask them all those questions. I think it's the right thing to do, so that when you do need them, it's not introducing yourself for the first time. It's like, hi, I spoke to you a couple of months ago. I've now got one that's live and ready to go, and I'd really like to work with you on this. That to me is the best way to create a new relationship. I just had a meeting with some 2 young guys there who are exactly that. They'd read my book. They referred to me by 2 or 3 of my current borrowers. They came in and they sent me their current project that they're funding. I modeled it up into a desktop kind of discussion paper, sent it to them. They came into the office. We got to meet each other, talk through a couple of scenarios. And then now when they've got a live deal, they'll send it through and we'll jump straight on it. We know who they are, what they've done, what their approach is, what their business model is, and we can then help them in the best way we can, as opposed to just sending in a FISO saying, give us your quote. It's like, well, hang on, we kind of want to, eyeball you and get to know you before we just start sending out random quotes to random people. So I definitely recommend that, not just with us, but with, as I say, builders, valuers, QS, other people in your team. You probably do it with your architect as well. You want to get to know them and understand how they approach things.
Yeah, and the book that you're referring to, Dan, is Constructive Finance by Dan Holden, and a very worthwhile book it is reading. I have it as a recommended reading for people in my training and to anyone else who's in development.
Thank you. Yeah, so we were Amazon bestseller when it launched, and I think we've just ticked over maybe 1,100 copies sold. So it's constructivefinance.com.au. And if you buy it through that website, I'll sign it personally, write your name and send it out to you. But it's also, I think, available on Audible as well for people that like to walk and listen and read.
Yeah, I think at one point I saw that it was a high it was highly common that people were buying your book and my book together, which I thought
Saw
was
that. Yeah, was it like some type of bundle deal or whatever they were
a
saying?
bundle
It was like
deal. People were buying it together.
Yeah.
I thought that's perfect.
Yeah, no, it is good. Good to see.
Yes, it's a really important point that you make about trying to find a team to put together, or putting the team together before the project actually comes about. And a lot of people, I think, when everything's running smoothly, you just have a view of somebody providing a functional service, and then that's it, like a QS. I just need the report once a month, just spit that out, and that's all. I'll pay you $1,000 or whatever it is. That's all I need from you.
Yep.
And that's probably the case when everything's going smoothly. But when you're facing some challenges, that's when you really start knowing who the good people are, who've got your back, who've got the experience, can guide you through it, give you advice. And I think we've been through a period like that, and the real cream has come to the top. So now is a very good time to be reminded that you need to go searching for the good people before your project starts, because when it hits the fan, it's too late to switch out your QS when you're halfway through and things start going wrong.
Exactly right. No, hit the nail on the head there. It's good.
All right, Dan. Well, let's hope. That's one thing I did want to say, is that the outlook is still fairly positive from a development point of view, I think, because we've got all these people coming into the country. You've got reduced capacity to be able to build. People are a bit apprehensive about getting builds started. So if you can get a project started and finished, I think you're going to be looking pretty good over the next.
I think so. And yeah, that's why I say many lenders won't fund a project that isn't necessarily 20% perfectly picture perfect viable. I take a slightly more optimistic view, and I think that the lack of job starts now means that in 12 months when that project is finishing, there's less competing stock. I think the valuations might go backwards at a rate of knots. If they have in the last 12 months, I think that's over, and that we'll see more stability going forward. Population growth, like you say, is going to underpin a lot of that. I'm seeing a lot more build and hold projects coming through now, as opposed to build and sell. And that, again, we're in support of. So yeah, I'm the reason I look at it in an optimistic view is because in 12 months, when you go to put a for sale sign up on that completed product that someone can move in 30 days' time, there won't be a for sale sign on every third house like you might have seen in the last 12 months. It feels like every third house has a project launch and a street record and a suburb record and all this kind of stuff. I think fast forward 12 months from now, there won't be as many things finishing. So you'll have that opportunity to let the market dictate your price, as opposed to I'll take whatever you can get me. It's the market actually competing and trying to buy that product because it's such a great project and a great location. You'll see the market there to buy it and even potentially overpay for it.
All right. And if people are interested in finding out more about Holden Capital, where should they go?
Yep. So hcp.fund is our website for borrowers and investors alike. We're now opened up to new investors. We've just ticked over 400 million that we've raised from our investors over the last 6 years since we started on the lending side. We've had no loss of capital. I think we're averaging about 12.8% per annum return to our investors. And yeah, people are investing in pretty stable kind of developers and borrowers, which is good. And yeah, on there's a product sheet that people can download to have a look at the types of things that we're lending on and the types of things we can do. And yeah, once you've got that scenario, feel free to contact me or one of the team, and we'll quote it up for you.
I actually think you were on the podcast for the first time about 6 years ago. Dan,
there you go. There you go.
You've been coming on the show.
Yep. Excellent. That's good. Good milestone.
One of our very first guests. So no, congratulations on getting to that stage. That's really awesome.
Yeah. Thanks, mate. Appreciate it.
All right, Dan, as always, fantastic to have you on the show. I promise I'm not going to leave it 12 months to get you back on. So we'll hear from you at some stage in 2024. And thanks for getting us up to speed with what's happening.
Awesome. Thanks, Justin. Good to chat.
See you, Dan.
You've been listening to the Property Developer Podcast. Tune in next time for more tips, ideas and inspiration to take your developing to the next level. For more developing love, make sure to visit propertydeveloperpodcast.com.